relation to domestic transfer pricing. And this session, we will now be looking at the rest of the sections where domestic transfer pricing has been made applicable. For dealing with this topic, we have with us Dr. Hasnain Shroff, who is a fellow member of the Chartered Accountants Institute, also a doctorate from the Mumbai University, with the subject of management of transfer pricing strategies for multinationals. He is a partner in global transfer pricing services in KPMG, has over 15 years of experience in issues relating to transfer pricing, and has also international experience on secondment to Australia, where he has assisted several Australian companies to set up operations in India. Apart from that, he also regularly speaks at various forums, including the chambers. With that brief introduction, I request all of you to welcome him with a loud applause. I also request our Delhi member chapter, Mr. Dipendra Kumar, to welcome him with a token of our appreciation. Without much ado, we'll begin with the session.
Yes. Okay, so it's just 1 minute to say before good evening to all of you. So I will wish you all a good evening. First of all, let me thank all the office bearers of the chamber for giving me this opportunity. And it's a privilege and an honor to talk to you on a topic which is very close to my heart. So, being the last session of the day, I'm cognizant that it's going to be a little bit of almost a tiring day for you all. So I will try and see as much as possible. I'll try to be less academic and more practical issues which we are facing in the tax holiday matters on domestic transfer pricing. Just as a backdrop, we have seen the litigation in the transfer pricing arena almost going significantly in some kind of a 40 to 50% growth every year. And the last year, right now the numbers, I don't know what the numbers will come out for this last cycle, but the previous cycle was around some 70,000 crores. Now, the point is that this essentially the numbers which were there were in relation to international transfer pricing, transactions of cross-border. And 2012 Finance Act, we saw domestic transfer pricing being introduced. And till now, we haven't seen the corporates really being awakened to the issues on domestic transfer pricing, or they are not very, very sensitive. And this is what I just recall when international TP was introduced in the initial years. Not many corporates were very, very sensitive to it. It's only when it came back and hit them very hard that people awoken, and thereafter it became a big flourishing profession for a lot of professionals, including myself. And this is the same thing which I'm seeing, that for domestic TP as of now, we have not seen that big concern because it is mainly concerning the Indian corporates. But let few years go, few assessments happen, and you will find the same wave of litigation happening and demand for domestic TP professionals going up significantly. So that's the good news for all of you who are looking at domestic TP as some kind of area to specialize on. Just as a backdrop, now we know that 2012 the finance minister, leveraging on the observations of Supreme Court in GlaxoSmithKline, he introduced transfer pricing to certain domestic transactions, essentially transactions covered under section 40A2B, and to certain transactions, tax holiday transactions. Now, what happened in that Supreme Court decision, very briefly, I'm sure everybody has heard about that particular thing, but if you look at it, the Supreme Court had emphasized and had tried to direct the government to bring transfer pricing only in non-neutral transactions. So the subject matter in the Glaxo decision was where there was a cross charge between the two same group companies, and there was a fight which went to the Supreme Court. Supreme Court said, what are you fighting for? One is claiming deduction, other is offering as taxation. Where's the leakage to the revenue? And thereafter it gave a suggestion saying that even if you want to make this particular thing subject matter of transfer pricing, then the law needs to be amended. And Supreme Court gave some guidance over there, saying it gives recommendations that it should essentially be relevant in cases where there is a tax arbitrage, essentially involving transactions where one entity is loss making, other is profit making, one is enjoying holiday, another is tax paying entity. Now and then it gave a recommendation to the CBD saying that they should come apply transfer pricing provisions to domestic transactions, and that they should come out with some kind of guidance or change the law. Now based on that, the law has been changed, but unfortunately the way the law has come out is it applies not only to tax arbitrage transactions, it applies to all transactions which are covered under 40A2B as well as the tax holiday transactions. So essentially, if you look at it, Supreme Court tried to bring out saying that if there is one loss making, one profit making, then there is a tax arbitrage, and that is where you should look at trying to apply these kind of provisions to see if there is a tax leakage. Similarly, tax holiday and tax paying company. Now because yes, obviously in both these cases there is a loss to the revenue, and that's the reason TP should be made applicable. But unfortunately, as I said, the law has now come out to cover without exception whether it is a neutral, tax neutral, or a tax arbitrage transaction. Both are subject to domestic transfer pricing. And there is one particular residuary clause which the government has kept in section 92BA, which actually defines the specified domestic transaction to say any other transaction that may be prescribed. Now I can tell you the day is not far that you will find some transactions further being notified, especially the reason being, if you look at section 188 of the Companies Act, which requires not only the expense side, even the income side to be subject to ALP, and if that is not followed, there are going to be a lot of I would say consequences. So eventually, if the law somewhere in other law the income side of transactions are also covered, then the government would be tempted to even cover those transactions under the income tax, because that really becomes a very big area for them to look at. It's literally like, today if international transaction is one, after they make such kind of amendments, the domestic transfer pricing will be maybe 500 or 1000. So the ratio of trying to garner the new avenues will be very, very high. So as we advise our clients, it will be very, very helpful if we also tell them that not only take cognizance of the current law, which only talks about essentially 40A2B, which is expenditure side, and tax holiday, yes, that covers the income side also, but to factor in even those transactions which are on the income side and still not covered under the SDT definition. Yes, and the other part is when the domestic transactions all taken together exceed 5 crore, obviously it gets covered. So this was broadly the backdrop, of more of a warm-up to what we would like to discuss. I would just discuss some provisions relating to the tax holiday, and thereafter we will dive into the relevant issues, and once we have debated the issues, we would just look into the few case studies. So broadly, if you look at it, the sections, the tax holiday sections which are there and which are very, very relevant in today's context are section 80IA, 80IB, 80IAB, 80IAC, ID, and 10AA. So most relevant is 80IA, where they're still quite active, 10AA, the special economic zones, and whichever 80IC and 80IB. So the two sections which are the most relevant for all of these, where 80IA 8 and 10 is imported into all these sections by way of a cross reference, and these are the two sections which we are currently going to focus on for the purpose of our debate today. So let's go to section 80IA 8. Now section 80IA 8 essentially talks about inter-unit transfer, And what I would just do is, as we go along, we can actually just go and read the relevant sections also to make it more relevant to the for the purpose of our discussion. If you look at section 80I8, it talks about, yeah, so it talks about where any goods or services held for the purpose of eligible business are transferred. Now, some of the words which are very relevant here are for the purpose of eligible business are transferred. So, goods and services held for the purpose of business, for the purpose of eligible business, are transferred to any other business, and vice versa. But there are some important words I'm emphasizing, and which we will really get into the discussion. So the first question which comes, and okay, let me just also read some other words which are here. Held for the purpose of any other business carried on by the assessee are transferred to eligible business, and again this is very important, and in either case the consideration, if any, for such transfer as recorded in the accounts of eligible business does not correspond to the market value of such goods and services. Yeah. So now 92BA says refers to transfer of goods and services as referred to in section 80IA8. Now, which are the transactions which are covered under section 80IA8? So let's say there are two units, there is some kind of a transfer of goods and services which happened, and let's say that those happen correspond to market value of goods, and market value of goods as per the amended proviso that it meets the arm's length criteria. So if it meets the arm's length criteria, then would it still fall under section 80I8? Because it is now corresponding to the market price. If it is not corresponding to the market price, then that is the reason that you have to get it covered under 80I8 and make an adjustment to the tax holiday deduction. Now this particular debate started that if I am meeting at arm's length price, then am I really covered under STT, and do I really need to report the transaction? Or the interpretation is that the moment I have a transaction, inter-unit transaction, whether it corresponds to market price or the ALP or not, it is subject to SDT and it needs to be reported also. Now if we look at the intention of the legislature, clearly when there is an inter-unit transfer of goods and services, it ought to be covered. There is an interpretation which somebody could explore, but I'm sure looking at the intent, courts will finally held that no, it ought to be covered, even though if it is at arm's length. the only thing which can then arise is, can we really try to rely on the, or rather refer to the proviso to take further strength to this particular argument, which says that for the purpose of this subsection, market value in relation to any goods or services mean A, the price that such goods and services would ordinarily fetch in the open market, or the arm's length price as defined in section 92F, where transfer of such goods and services is a specified domestic transaction. Now if you have to just take a meaning that way, that if I'm at arm's length price, then I'm not covered in this particular section, then this proviso, which is actually a circular proviso, will lose its relevance. So looking at all the things taken together, the right interpretation is that inter-unit transfer of goods and services ought to be covered. Now I'm not there are many things which we are going to discuss about this particular inter-unit transactions, but for first basic premise is that yes, the principle is that you will have to report it even if it is at arm's length price. The issues on eligible business and what goods and services need to be covered, I'm just going to cover in the subsequent slides. First I'm just discussing the basic of the sections. Similarly, 80I10, this essentially relates to one tax holiday unit of a taxpayer versus another taxpayer, which is a closely related person. So what does the section read about? It talks about where it appears to the assessing officer owing to the close connection between the assessee carrying on the eligible business. Again, the word eligible business, this is something going to be our focus discussion, to which this section applies, and any other person, or for any other reason, the course of business between them is so arranged that the business transacted produces to the assessee more than ordinary profits. So again, here the the reference point is that the transaction which is covered under ATI 10 are those transactions where the taxpayer is dealing with a person, closely connected person, and that is producing more than ordinary profits. So if that transaction is not producing more than ordinary profits, the question again comes in whether that transaction is subject to SDT. Now again, at least here the section is quite a bit more clearer, and the argument for the purpose of ATI 10 can be more I would say stronger compared to ATI 8 to take this particular premise. In fact, if you look at the form of the SDT, and in that if you look at between ATI 8 and ATI 10 transactions, ATI 10 transaction that comes in, it just says whether you have entered into any business with closely connected person which results in more than ordinary profits, and you have to say yes or no. But the same thing is not there at time of ATI 8. So the point again comes in, okay, so should we take a stand it's not SDT? My suggestion is when you look at the particular form, at the beginning of the SDT section you report it in the total quantum, and when you come to ATI 10 section, that clause, you may just want to say based on your benchmarking and support, saying that no, there is no more than ordinary profits, and that's why you report no over there. So effectively you are not going to give all the transactions over there in terms of all your inter-group or inter-related transactions, because you believe that the transactions are at arm's length. But the same premise may not be possible when you're reporting under ATI 8 particular transactions. Some just important terms, if you look at it, section 92 talks about ALP. ALP is defined in 92F, which takes you to 92C. Then again 48-2B talks about fair market value. This is the pre-amendment situation I'm talking about, and fair market value definition as such was never defined what it meant. It was a more broader kind of a term. ATI 8 spoke about market value. Again, market value is a very broad term. Compared to an ALP, the difference between ALP and the market value, I would say, is ALP identifies, works out a single point number based on your benchmarking. FMV, market value, can be any point in a range. So it could be anything. Anybody goes out in the market, let's say even a trader, a wholesale trader, when somebody comes to him as a customer, he may sell at a X price to a customer, and immediately the next minute another customer comes, he may sell it to another pricing. There are many dynamics which may happen. The customer sitting at the next shop will be getting another pricing of the same comparable goods. So the concept of market value, FMV, is very broad compared to when we look at ALP. ALP is a defined one single point because of the definition in the regulations that you have to work out one particular number. Similarly, ATI 10 talks about ordinary profits. So these are the concepts which are there. Now, if the transaction becomes a specified domestic transaction, then we clearly talk about ALP for all of them. So now the concept has moved from being broader terms to more a very pinpointed number, provided that transaction becomes a specified domestic transaction. So just to summarize out about market value and ALP, the distinctions. It is a market value, again I said, what you will fetch in an open market. ALP is never necessarily meaning there. It could be one of the reasons, one of the pricings to look at it, but you could talk about, let's say, cost plus method, TNMM method, so that could give you different pricing for the same particular transactions. So there are no computation mechanisms for prescribed for market value, and again, deviation in a market value, once you work out, there is no kind of a deviation just prescribed, and it's not required, I would say, because it's more of a range pricing point. And compared to the ALP, you will have just a variation of plus minus 1% or 3%. So the moment a transaction is SDT, including and more specifically for the tax holiday units, all these compliances which are prescribed in Rule 10D, everything becomes applicable parallelly as it is for any international transaction. You need to maintain all entity related information, the price related information, and the transaction related information. I'm sure somewhere it was been the transfer pricing documentation has been covered, so I need not go into this particular aspect. Unlike in international transaction where there is a limit of 1 crore above which you need to maintain the documentation, there is no threshold prescribed for domestic TP. So the moment it is a domestic transaction in terms of aggregating more than 5 crores, you have to maintain documentation without any threshold. So in a sense, 5 crore becomes a threshold limit for the transactions. And last, very important, along with this introduction of domestic TP, some penalty provisions were also changed, and they're very onerous, in terms of 271(1)(c) explanation 7, which talks about 100 to 300% penalty. Now the very worrying part of this is that explanation 7 says the moment there is a TP adjustment, and now for domestic transactions, meaning thereby in case of a tax holiday unit, if there is an adjustment made by the assessing officer, transfer pricing officer, then the levy of penalty is automatic. The trigger for the penalty is automatic, unlike in other cases of non-transfer pricing adjustments where he would take a call and satisfy himself before he triggers the penalty. In transfer pricing adjustments, the penalty trigger is automatic, and then the onus is on the taxpayer to demonstrate that he had undertaken this transaction in good faith. So the burden of proof is shifted on the taxpayers only for these kind of adjustments. And obviously the penalty is 100 to 300%. Then again, the non-maintenance of documentation for transactions is 2% of the transaction value, and that is why it's important to evaluate which transactions are covered and which are not covered. If there are some transactions which are covered and you do not report, then there is exposure of 2% of the transaction value penalty. And at the same time, we do not want to report transactions which are as such technically or legally need not be covered, because nobody in this world wants to over report to a taxpayer and help him, okay, please invite trouble for himself. So this is a fine balance which we will have to look, especially in the context of ATIA, which transactions are to be reported and which are not to be reported. And obviously the accountants report a small penalty of 1 lakh and another for a penalty for furnishing. So everything now applies in case of this tax holiday units also, all these penalty consequences. Okay, so let's look at few interesting issues now. Now the first issue is in relation to domestic transfer pricing being applicable for all these tax holiday units. What is the period of applicability? Now generally if you look at all these sections, they will talk about 10 out of 15 years, 10 out of 20 years, and assessee has an option, and many times we see that mid-year within that consecutive period also the assessee may decide to opt out because of losses. So the point is, which is the period for which the taxpayer has to comply, or these transactions become specified domestic transactions, and you need to maintain the documentation or supporting for it. Now there are 3 views on this, and we'll see which is the best view around it. If you look at so let me and I'll have to give a little take you through sections so that we are able to say why we are taking these particular 3 kind of alternate views. So 92BA talks about transactions covered in ATIA 8. Now ATIA 8 talks about where any goods and services held for the purpose of eligible business. So first of all, transactions referred to in 92BA take you to ATIA 8, and if only you are covered there, then you are covered. So now here the section talks about for the purpose of eligible business. So the unit has to be an eligible business. Now what is eligible business? If you go to ATIA 1, it reads where the GTI of an assessee includes profits and gains derived by an undertaking or enterprise from any business referred to in subsection 4, then bracket, here such business hereinafter referred to as eligible business. So the first time where eligible business is defined is in ATIA 1, which says that the business referred to in 4. Now you go to 4. 4 says this section applies to, and then it lists down all the businesses. Now, one very interesting point is that the moment I am in this business, it is eligible business. So when I set up this unit, it becomes a eligible. Now nowhere under 4, which defines which is actually the eligible business, there is a time limit prescribed. So the moment I become an eligible business, I have nothing where I come outside it as a non-eligible business, because the duration has been defined and it is completely dealing to 4 is defined in subsection 2. So the view 1, which is I would say really outrageous, but it's a just simple technical reading of the way one by one if you read it, is that the moment any unit becomes does this particular business, starts this business, it becomes a eligible business, and in perpetuity it is a eligible business. The period for deduction is different, that is separately defined, but the business, when you start this becomes eligible business. So does it mean that in perpetuity, because there is no end point to eligible business definition, the compliances and the applicability applies? This is really a very far-fetched kind of a view. The second is view is that in case when I start the business and I am eligible to claim 10 out of 15, then the second view is the 15 years entire period, that is the period for which I need to do the compliances. Entire 15 years or entire 20 years if the block is for 20 years within which I get an option. And why this obviously comes from subsection 2, which says give this option. So I am eligible for 20 years to claim the tax holiday. Within that I can claim any particular period. So that's the reason for taking this particular. And the third is only in the years when I claim a tax holiday, meaning thereby out of a 10 consecutive period, if I miss out 2 years and I don't take tax holiday in that, then those 2 years are outside the purview of domestic TP. So essentially only for the number of years for which I am going to claim the tax holiday, I do the compliances. So it could be only for 3 years, it could be only for 6 years, or it could be only for a very limited, or I decide not to take it at all. So initially I was eligible, I thought I will take the tax holiday at a later period, but I continued to make losses and I never claimed any tax holiday. So now between the three views, which is the most appropriate or the right view which needs to be adopted? If you look at the intent of the section, clearly view 1 is out. So we don't need to really worry about that. But between view 2 and view 3, I and my firm, we have debated on this, and finally we have come on the particular view that we need to consider the second view as the most reasonable and appropriate, because what happens is, in case let's say for the first 5 years I do not claim a tax holiday and I claim a tax holiday in the next 10 years, in the first 5 years there is an ability to maybe manipulate to some extent the pricing or transfer of some capital assets or any other things which can have an impact on the tax holiday working of the subsequent years. So if you were to just completely go by the intent of it, then this view seems to be extremely logical, that you do a compliance or the coverage for the entire period on which you have an option available, not just the number of years for which you are claiming the tax. So let's say in the third view, if mid-year somewhere you decide to opt out and you are not claiming tax holiday, and in that year you happen to do some kind of transfers or something, then the tax holiday losses could be reduced. Or the ability to manipulate, let's say you had a 10 crore loss, you can try and manipulate then bring that down to 9 crores, so that for the subsequent year set off the losses are less, so that your holiday can be higher. So those kind of things seems to suggest that the second view seems to be the most logical, appropriate, and should be supportable when they go into litigation. Now the most very hotly debated point about is the inter-unit transfer. See, when it happens to a transfer of goods and services, very clearly there is no doubt about it, but obviously you will find in most of the cases that there are, let's say, 5 units in a company, and there is some lot of common expenses which is allocated to the units. Now the question is that can this expenses which are allocated amongst 5 units be subject matter of SDT? Because for ATI 8, what is relevant is the income and the expenditure side. So the point would be, if head office is providing some common facility or some common kind of arrangement, would that tantamount to a service being provided by head office to the unit, and hence it becomes subject matter of ATI 8 transaction to be reported and to be benchmarked. Now, so again, there are two views around this, and we will see which is the better view on this particular matter. So the point around there is very simple, that in case the unit, if we were to treat the unit as separate independent entity, and if this unit was not to take avail the services from the head office, then they would have availed it from some third party. So obviously in that sense it is a service, and hence since it is service, it needs to be reported. But there is a separate view around it. What it talks about ATI 8 is, first of all, there has to be transfer of goods or services between the units. And now let me just read this section a little bit, a few wordings again. What it says is, where any goods or services held for the purpose of eligible business. Now, can somebody say that these services are being held for the purpose of eligible business, or vice versa? Head office is not in the business of rendering this particular service. So this is more of an allocation between two units. It is not that head office is in the business. So let's take a scenario where a head office was in the business of doing some back office or call center services to third parties, and they also do the same thing for my other unit. Then the answer is explainable, yes, that you need to cover these transactions. But simply because this is a common facility which is being shared amongst 5 units, it doesn't become a marketable service. And there is a tribunal decision which clearly supports this fact, not in this particular context. It's the decision of Nahar Spinning, which talks about that these services are not subject matter of ATI 8, they are subject matter of ATI 5 or 6, which requires that all allocations should be done in a right manner before you compute the profit. So there is no question of transfer of service, and hence ATI 8 is not triggered, and hence you need not report this particular transaction. As I understand, initially there was a complete view, a consensus amongst most of the companies and the generally, that these transactions are reportable. But I believe, like, based on this particular interpretation, I think we can take a clear stand that this is not reportable. Only thing you need to be cognizant about the fact is that, is this some kind of a service which is marketable? If it is marketable, then clearly, so something, let's say one unit is supplying electricity to the other unit, clearly it is a marketable service. But where there are common facilities which is more for the purpose of sharing of cost, it is not intended to be a service. Yeah, so so that's the reason, like, we can take a stand that these transactions are not subject matter of SDT. But this logic will not apply in case of ATI 10, because ATI 10, there is it's not a question of cost allocation. It's actually a cross charge happening from one company to another company. Now, in that scenario, it would be a little difficult to take the same premise to say, because ATI 10 also doesn't talk about transfer of goods and service. It talks about ordinary profits, which factors in even the cost allocation. So even if you were to take the stand that this is a cost allocation between two companies and is not a service, still, for the purpose of ATI 10, this would be relevant. Now, there have been questions surrounding, and this is very, very vexed question, and I don't know what answers to finally land up on this. But if you look at, there could be a head office which is undertaking the research and development, and there are units which are manufacturing, and more so, let's say in the case of pharmaceutical companies, all units are manufacturing, the head office is doing research and development. The question will come in whether that research and development cost needs to be allocated while computing the profits of this particular undertaking. Now, this has been subject matter of litigation, and finally the conclusion of the decisions coming from the courts is that in most of the cases, the courts have laid down saying that when you want to look at the inter-unit allocation of expenses, there are certain expenses which need to be allocated, certain expenses which need not be allocated. So there is a Madras High Court decision in the case of, I'll just tell you this decision. Tide Water Oil Company Limited. Now, in this decision, court has clearly said it's not necessarily every expense of head office needs to be allocated. Only if that particular expense is directly relevant for the functioning or the manufacturing of that unit, only then you allocate. And there are some more other decisions which, if you want and you are of interest, I can just lay down. There is another decision of Hindustan Lever. Yeah, I'll just give you the citation. Again, this is Madras High Court, where the court said that all the expenses which are of general administrative nature need not be allocated for the purpose of computing the. Now, in other decisions of Zandu Pharma and other decisions, what the court said is, especially in the context of R&D, again the court said that in one of the case, the court said that you need not allocate the R&D expenses. And the reason being, the court said that what the head office is doing is actually doing R&D for future, and the products which are being manufactured, for that they don't need this R&D. So this is not directly relatable to the manufacturing of this particular product currently being undertaken by the unit. But if you look at it broadly, generally the understanding is any expenditure which is at the head office, you just do an allocation on some kind of allocation key. But here are the decisions which will surely help you to remove all these expenses out, so that you can actually increase your tax holiday. So these decisions, if you really fall into these particular category of expenses which are completely delinked to the functioning of the unit, then you first remove them out completely. Don't even allocate. You have a support available. Second, after you have allocated the expense, there are some second basket which is an allocable. You decide whether it's a marketable service or it is a non-marketable service. Only if it is a marketable service, then that will get subject covered under the SDT. If it is a non-marketable service, you don't need to again report it. So just broadly, don't go and categorize, okay, head office expenses, common expenses, allocate and divide amongst all of them on the basis of an allocation key. Look into it, try and remove some expenses, don't allocate them at all, even for the computation of the unit. Two, for the purpose of computation of unit, break them into two parts: allocable, non-allocable. In most cases, I would say, in most cases, these common expenses which are allocable would not form part of SDT, so not required to be reported. So your question is that there's a pharma company which is doing R&D and in-house R&D. So when you say where they are doing in-house R&D, for whom they are doing? And then why are they doing contract manufacturing for the other? See, contract manufacturing means they are doing for somebody else. So it is contradicting. Okay, so the point is you are doing R&D on the basis of which you are doing some manufacturing. There is a spare capacity available for which you are doing a contract R&D. Clearly, when you are doing a contract manufacturing, first of all, whether, like, who would be the manufacturer in that particular contract manufacturing to claim the tax holiday? If you get categorized as a manufacturer, then I don't think the R&D cost has any link to this particular manufacturing activity. So you need not allocate that. But for your existing manufacturing facility, if this R&D is relation to that particular manufacturing, or it is relation to the future research for new products, that is what you have to distinguish. If it is in relation to the future products, then you have a support available to say that you need not allocate those R&D expenses right now. But if they are in relation to the current manufacturing which is happening and you need to constantly upgrade that and use that as a part of the process, then you should allocate that. Yeah. Okay, now earlier you heard about 2 views, then you heard about 3 views, now you'll hear about 4 views. So yeah, so this ATI 10, it talks about, as we saw, talks about closely connected person. Now, closely connected person is nowhere defined in ATI 10. So what is the meaning of ATI, closely connected person? Because if we do not know the definition of that, then how do we cover the transactions which are within the ambit of ATI 10? Now, one view is that you look at what is the definition given in 40A2B of related party, and why you should look at that. Because when you look at that form 10CCA, which is for the purpose of claiming the tax holiday or computing the tax profit, in that form somewhere they are talking about closely connected person, and they are making a reference to 40A2B. So that gives an inference that the intention of the law is maybe to refer to 40A2B relationship. Second, 92A. When this section got amended, SDT, and there was this rule 10A which was introduced. In that particular amendment to the rules, they have actually defined associated enterprise shall have the same meaning assigned to it, and so 92A, and in respect of, so somewhere they are trying to link it to the SDT. So maybe that is giving a flavor that let's look at 92A definition, and more so it is also in the context of international TP within the ambit of chapter 10, where now SDT also resides. So let's look at 92A also. The third definition is the accounting standard AS 18, where the separate definition is given of what is related parties. And the third is take all of them. Now, here I would yeah, right. So, but yeah, now the 5 years, so that's, you're right. So, but somewhere it is now almost similar, but you're right, we can always take that particular thing. So, if you look at it, which would be the one to take out of this? Because ATI 10 just is completely silent. It says with closely connected person. Now, where do I get a meaning of that? The intention, let's go to the intention. It is trying to cover transactions wherever it is giving more than ordinary profits. And if in that section itself it's saying, or for any other reason. Now, they are saying not only for the relationship, but for any other reason. Meaning thereby, even if the relationship is not there, but somewhere you are able to arrange, they are trying to plug that. So in such cases, the intention is to cover all scenarios where the transactions are generating more than ordinary profits. In light of that, it would be better, and I would say conservative, to consider all the parties which are defined in all these sections. You can't leave it around. And then because what will happen is, tomorrow if somebody puts an allegation, it will be very, very difficult, and these penalty consequences are very onerous. And if let's say you do not fall in 40A2B definition, but you fall in 92A, court would say, see, somewhere the court is the act is trying to bring that relationship under 92A. You may not fall under 40A2B, but 92A similarly is intended on the same lines. And if you have arranged your affairs with them on those lines, then you need to cover. So I would suggest, on my view would be, is to really, there is no guidance available, but the best approach to this particular solving this mystery is, if you're falling in any of these definitions, please treat them as covered for the purpose of ATI 10. Yeah, now the excess profit versus short profit, and international versus domestic TP. Now, clearly, more in the context of ATI 10, when you are making more than ordinary profits, that's the reason which is an area of concern, and those particular profits need to be disallowed. If the profits are less, then the question is not there. And if you look at it, there are certain judicial precedents in the context of, especially in the case where there are a lot of cases where in international TP, the SSE had made a profit of, let's say, cost plus 80%. And the TPO came with the comparable benchmark was 40%. So TPO accepted, saying, yes, I'm okay with that. But the AO started to disallow that, saying that, oh, you have actually earned excess profit, so I'm going to disallow that under the ATI 10, because they are earning. The premise of the AO was that you are earning much, much more than the price determined by the TPO as the ALP. So it's like a double-edged sword which started. A lot of cases underwent that particular litigation issue. Now, clearly, if you look at it, the moment a transaction is an international transaction, it is outside the purview of SDT. Okay. As in case a transaction is SDT, then you have those methods applicable. If it is not SDT, then the old law or the unamended law continues, prevails, where you do not have any recourse or reference to the six methods. In those particular scenario, what does it happen? So in such cases where the assessing officers or the TPOs have tried to contest that assessee is sending and earning profits from exports, they are making huge profits and they are trying to abuse and claim excess tax holiday. All these matters went to the court, and by and large it went in favor of the taxpayer on a number of arguments. So specifically these 2-3 cases which I have just presenting the substance or the summary of that is, in that case there was a JV in India, 70% owned by overseas, 30% by the Indian entity. When the export happened, what the arguments were produced by the taxpayer saying that, look here, if you believe that we are trying to get excess profits into India, then remember one thing, and from my overseas parent, then 30% of that actually is going to the JV partner. No commercial man would want to do that particular thing. Two, why does this concern of ATI 10 come in? Because if somebody claims a higher tax holiday, there is another taxable unit who is getting a higher cost and reducing their tax liability. Here is a case where I'm exporting. In any case, that is never available as a deduction in India. So where is the erosion of the tax base? In fact, if I were to bring lesser money, and let's say at 40% instead of 80%, then there would be a loss to the Indian government. And how? Because if the less profits sit in India, when I declare the profits back, the DDT will reduce. And third, the fourth point, in that particular benchmarking the TPO had adopted, there was one of the comparable was 87%. So court said that the ALP and the fair market value or the ordinary profits, they are two different concepts. You cannot bring both of them on the same parlance. There is nothing in the law in case of an international TP that you say you will have a benchmark with the ALP as ordinary profits. So the assessing officer has to work out that how he is saying that ordinary profits in this case would have been 47%, especially when one of the comparable in their case was around 97%. So there is one comparable which is earning 97%. So that becomes a reference point. ALP somewhere you bring out one number, but in case of ordinary profits or in case of FMB, it could be a complete range. So on all those premises, the court ruled in the favor of the taxpayer, and this has been some similar kind of a similar trend where courts have been holding in favor where this kind of good arguments are available. So if you were to just look at the, so I've covered the Twizerman case. Okay, the only tweak to this now would be is, let's look at excess versus short is over. Let's look at international TP versus domestic TP. If one unit, which is let's say enjoying a tax holiday, is exporting some goods to its overseas A, and it is also selling the goods in the domestic market and enjoying the tax holiday, let's say it's a backward unit, so it gets a tax holiday from both sides. The issue would be, when it goes to international TP, I need to earn profitability above the comparable margins. But when it comes to sale in the domestic market, I need to earn profits lesser than that. So there is a conflict between an international TP and domestic TP, and I've covered one of the case studies on that to see how we can try and resolve that particular situation. Because you're on the face of it creating a contradiction for yourself. So either the TPO will say I make an adjustment, or the TPO will say I'll make an adjustment on the domestic TP. Okay, now the way we do self-adjustment in international TP, can we also evaluate or consider these kind of self-adjustments for the purpose of tax holiday when we are talking in the domestic? So if you just look at a working of this, a very simple case where a taxpayer is eligible for ATI, chapter ATI, and the issue is where they are buying something from another company, and then you want to make it's an excess price. So let's say if you were to really make a self-adjustment and you say, okay, I bought an excess price, I'm making an adjustment and I'm increasing my profits, and thereby I'm claiming higher tax holiday. Now, since in this case, because the self-adjustment is made by myself, not the TPO, 92C4 proviso will not be applicable and I should still be eligible for the tax holiday, because this 92C4 proviso is also applicable to adjustments made by the TPO for tax holiday units. So I'm sure, like, you're aware that when this proviso works that in case if I claim a tax holiday and adjustment is made by the TPO, then I'm denied tax holiday on it. So what I will do here is, in case at the time of filing the return I realize that yes, I have overpaid than the market price based on my benchmarking, then I should make an adjustment and then claim a higher tax holiday, because if the TPO were to increase my profits, then that will not be eligible for the tax holiday. But let's say we do it kind of a so reverse scenario where the AO does it, then there is going to be an excess the extra tax liability which will come in. So merely by you being little sensitive with the filing of the return, if you make a self adjustment where you genuinely believe that there is some kind of a TP adjustment to be made, you can be salvaged from this particular payment of excess tax. Okay, so let's look at some quick case studies. We can just what time? 5, no? Okay, fine. So no problem. I think we can go pretty fast because the issues are broadly covered. We can just look at it. So let's look at a case where there is MCO, which is in the manufacturing of soaps, and it is claiming 80 IC benefit. Now MCO is holding 20% stake in DECO, which is a domestic company and a distributor company, tax-paying company in India. It's just a simple distributor. MCO sells goods to DECO, which is the domestic distributor, as well as sells the goods to its overseas AE. Now overseas AE is actually branding the product in its own market and then selling the goods, and DECO is selling the goods in the name of MCO's brand. Now if you look at it, MCO's profit margin for sale to overseas AE is 15%, and its sale to DECO is generating a 20% profitability, and the industry broadly benchmark is around 10%. Now in light of this, let's look at what could be the implications coming out of it. And the questions first of all would be is, I have a benchmark which talks about generally companies like me earning 10% profit. I am earning 20% profit from sale to my domestic company, and I'm enjoying tax holiday on that, and I'm getting 15% profitability from sale to overseas company. So on the face of it, prima facie, it seems okay. On international TP, I'm better off because benchmark is 10%, I'm earning 15%. But for a domestic company, for the sales to the domestic, I'm earning 20% profits when my benchmark is 10%. So let's see. Not to jump on the prima facie, let's go into the specifics of it. Yeah. So let's look at the solutions. What could be the cases? Obviously, since the sale is happening to the overseas group company and they are selling in their own brand name, and they are I would say full-fledged distributors, and they could be also categorized as their complex entity, I would tend to look at benchmarking using myself as the tested entity for this particular transaction, and I would benchmark myself saying that the benchmark is 10%, the broadly the similar companies are earning, and I am actually getting 15%, so I'm completely at arm's length on that. And this would be clearly supported by my FAR that the overseas company is investing in the market, and they may be repacking, branding, different small packages, everything, whatever it is. So they are selling it on their own brand name. Now coming to DECO. Now DECO is a scenario where if we just go by the same approach of testing using myself as a tested entity, then I'm surely facing an adjustment. But the point is, now here is a case where we need to get into FAR analysis and see that what is the function which is being done and which is the right entity to be selected as a tested entity. So here is a case for which we will select the domestic, the D company, the distributor company as a least complex entity, and adopt that as a tested entity for the purpose of my domestic transactions. And since the domestic company is earning maybe 5% or 7%, which is comparable from their sale, my transactions are not overly priced, and hence I should not be denied a tax holiday even if I'm earning 20% profits from sale to this particular distributor. So this is how, like, if we get more and more specifics and try and segregate all our the heart of transfer pricing, which I called as the FAR analysis, if we get into the answers will be there for us. So this is one of the reason which we can just try and look at it. Now the just a variant of that was, if suppose sorry, okay, so whether sale of goods to both DECO and AEs at cost plus can be justified. So obviously, as I said, we need to really bring out a distinction that both are different. We don't want to use them as a comparable basis. And obviously, if I were to work on a cost plus 10%, then separately benchmark, use the comparable and work that out. Okay, let's look at the second case study. These case studies will be very simpler for us because we have discussed the issues in the past, so we can just try and implement those particular issues into this practical situations. Now this is a case where we have a holding company which has two separate companies. One is a PICO, which is a power unit which supplies electricity both to EMCO, and which is a group company engaged in manufacturing of products, and it is not enjoying any tax holiday, so it's a non-tax holiday unit, EMCO, and it is also selling supplying power to third parties. PICO is claiming a tax holiday, and PICO charges third parties at the rate of 10 rupees per unit supplied. Now the point is, and this may not be the exact example which may happen in practice, but there's a conceptual discussion which is very important. That's why I brought this particular case study. What will be the implication if there is no charge, or let's say a very negligible charge by PICO to EMCO for supply of power? So here we are also thinking from not only from the tax holiday but from 37(1) perspective. So the moment I am not claiming an excess tax holiday, clearly for the PICO, which is supplying the power unit, nobody can touch it from a SDT perspective. And for EMCO, because it is a taxable unit and they are getting at a lower price, 48(2)B also doesn't apply to them. But the interesting or the very important point would be is, can the expenses incurred by PICO be disallowed to it, saying that could there be some expenses incurred as to why they are selling at a less than market price when they are selling to third parties at 10 rupees per unit, and if they are selling at significantly less price and which is resulting in a loss, there could be some kind of a contention that are we incurring expenses on behalf of somebody else's business, and there could be 37(1) issues due to which in case even if we have losses, the carry forward of those losses could be questionable. Third case study. Holdco, PICO is a tax holiday unit supplying power to EMCO, which is also a tax holiday unit. So both are tax holiday units. PICO is completely supplying at a cost plus 10% markup too. The questions to be looked at is, what would be the implications for transaction between PICO and EMCO if the arm's length margin works out to 15%? So currently the transactions are happening at cost plus 10, but the arm's length margin works out to 15%. Now clearly from a PICO perspective, I am charging less than the arm's length, so my tax holiday is not more than ordinary, so I have no issue. But when you come to the other side, EMCO, can the contention be there that I am earning more than ordinary profits because somebody else is giving me at a lesser price? So there is where the possibility of some kind of a disallowance of tax holiday happening. And especially in a group which is enjoying having a lot of tax holiday units, this is going to be the biggest issue, where you'll consistently find that one unit having being disallowed a tax holiday, and possibly another unit also facing some kind of a disallowance because of 42, 48(2)B disallowances, which I will cover subsequently, and there could be a double whammy to it. So the net substance message is that now going forward, dealing at arm's length ALP is extremely critical. earlier you had a long band of broad range within which you could transact, but now going forward you will have to transact very very microscopically in a particular small range. If you do outside that, then you are very very likely to face adjustment. And this is what I was saying, that let few years go and you will find significant amount of litigation happening on all these kind of issues. Similarly, if let's say the arm's length price was 8% and I have actually sold at cost plus 10% in the same as a variant of that, then I have actually earned more than ordinary profits. But let's say if I'm able to fit myself in the plus minus 3%, then I'll still be home. But if I don't, then it's a excess tax holiday and will be disallowed. At the same time, for the entity who is buying goods from me, which is MCO, they are buying, instead of cost plus 8, they are buying at cost plus 10%. So they are buying, they will not have a excess tax holiday under 80I10 issue, they will have a 40A2B issue. Are they overpaying from a related entity? Because here the transaction will still be hit by 40A2B. So if they fall in the plus minus 3%, they will be saved. But if they do not, then they will face a disallowance on that. So you will have, in case that this doesn't fall, you will have a disallowance in PICO, you will have a disallowance in MCO also. So these are the cases which we need to be a little careful about here. Okay, so I think we discussed that somewhere, but again we can just go through this case study also. Again, MCO or tax holiday unit. MCO has ESCO is actually processing those goods and sells the same onward. It is a non-tax holiday unit. During the financial year 13-14, okay, MCO charged ESCO 100 crores for the goods sold. Now we will look at a simulation of in case if the price ALP which is determined is either higher or lower, then what happens. So case 1, if the AO determines the ALP of the goods at 120 crores, then what are the implications in the hands of MCO and ESCO? And what would be the implication if the AO were to determine the ALP from MCO to ESCO as 80? So here would be the situation. In case of first, let's look at the MCO scenario. If the AO determines that the ALP is 120, then what would happen is the issue would be he would not touch it because we are not earning more than ordinary profits. In case of MCO, his concern would be he will have a power to touch you if he finds that you are earning more than ordinary profits, and he'll reduce the tax holiday. But here you are not earning more than ordinary profits, you are earning less, so he will not touch you. Parallelly, for ESCO, and it will be relevant from 40A to B. But since the ALP determined is 120 and you are buying at 100, the 40A to B will not be hit. 28 for whom? In terms of how would you just try and bring under 20FO? So would you say this is a benefit because you are paying for it? Yeah, but paying less. Okay, what happens is when I actually see what happens, how you are paying less. Here the concept for the purpose of 40A to B, they will say no disallowance will be made under this section if you are earning. So you are saying would it be a perquisite? I would say benefit would it could be challenged, there's no doubt about it, but still I would say there would be strong grounds to say because you are buying a good and there is some kind of a yeah, yeah, correct, yeah, so correct. Yes, no, I think it's a very relevant issue which you raised. But if you look at wherever the law wanted to make an adjustment with reference to the pricing, the benefit arising of pricing, they've introduced transfer pricing. So now, where any area there is a pricing advantage which happens, it will be very difficult to bring the perquisite valuation into that. So I think could be yes, somebody can try to use, but it may be a little difficult for. Correct, correct. That no, so if you are doing it zero, which is what I said in the example, is more to bring out a concept, not a kind of a real life situation, because it can never happen. But the concept would be as to what would be the implication. So again, would be relevant point in terms of perquisite, but I still feel wherever the statute wanted any advantage to be factored in, they have brought transfer pricing to that. Now, if here there is a transfer pricing and I have 48 2B also, and the courts, the law says if I'm buying lesser than that, then it's okay. Then why it should be considered as a perquisite? So I would feel there is a strong support to, but yes, very valid point to like. Now let's look at a case where the ALP is determined at 80 of my sale. Yeah. So now what will happen is he will reduce my tax holiday. He will reduce my tax holiday. I have actually, if you look at it, just one second, let me just go back. Yeah. So he will reduce my tax holiday and bring it to tax. Again, if you look at it in terms of ESCO, since I have actually reduced, I should have actually bought it at 80, the processing cost, my taxable income increases to 80. So if you see that there's a double kind of a hit which happens in this scenario. So these are the cases which we should try and avoid getting into, and just plan it around. So if you're under ALP within that small band, which is most critical now going forward. Okay. And just now, the summary of all the case studies is something brought out in these 3 illustrations. And if you keep this in mind, I think it will really drive home the perspective. Look at X limited, which is a non-tax holiday unit in all the scenarios. Y limited, again, it is non-tax holiday in the first, but tax holiday in the 2 scenarios. Now, when the sale happens from Y to X, okay, the sale is at 120. In all scenarios, we are looking at a sale at 120. In scenario 1, the ALP should have been 100. So now there is going to be a disallowance in the hands of X under 48(2)(b), very clearly, because X limited has bought the goods at higher than ALP, which is 100 rupees is the ALP, and they have bought at 120. So 20 rupees is going to be disallowed. Now let's go to the second illustration. Y limited, the only difference is Y limited becomes a tax holiday unit. Okay, now here again the sale is actually happening at 120 against a ALP of 100. So what will happen is the TPO will say that you should have sold the goods at 100, you have sold at 120, so you have got excess profit of 20. So 20 disallowed in the hands of Y. Now go to X limited. You have bought the goods at 120 instead of 100, so he will get a disallowance of 20. So as a group, you have got a double disallowance of 20 plus 20, which is 40. Now let's say you become very conservative, so I don't want any litigation, I will now start dealing below ALPs. Then what will happen? So Y is a tax holiday unit. Instead of selling at let's say you sell at 80, the ALP determined is 100. So what happens? Y limited will enjoy lesser amount of tax holiday. The potential to actually earn the tax holiday was at 100, but now you are conservative, so you have lost the 20 rupee advantage and you are going to pay tax on that. For X limited, they have bought it at lesser than the ALP, so for them there is no disadvantage. But in all 3 scenarios, if you look at it, all 3 scenarios, any scenario, if you do not deal at ALP, you are going to face some kind of a tax inefficiency. So the message is that going forward for all the tax holiday units, the key thing is to make the corporates realize, the clients realize that the concept of FMP was different. Now we need to deal at ALP, and for that there is some element of work required, and if not, then it will come and haunt us, a very big problem in the time to come. I think that's the end of my presentation, and I'll be happy to take any questions if there are.
Sir, in case interest-free loan is given by eligible undertaking to non-eligible undertaking, whether that would amount that the eligible undertaking has more than ordinary profits because it is not paying interest to the non-eligible undertaking.
No, so the eligible undertaking is
Receiving loan from the non-eligible undertaking,
yes.
and it is not paying any interest to the non-eligible undertaking.
Yes,
So whether
yes.
this would amount that the eligible undertaking is earning more than ordinary profits?
Yeah. So there are two ways to look at it. One, if it is it is not a question of ATI 8 as I understand, because one unit and other unit, if when you're talking about of the same entity, it can be head office giving a loan to the yeah. Essentially, if it's your own funds, there is no question of claiming a tax holiday or the interest deduction. So your tax holiday will not be impacted. But if you are borrowing, and that borrowing is directly linked to that particular unit, then I think you need to make a provision, allocate that interest to that particular undertaking.
Capital exempt and non-interest bearing.
Sorry.
Because the courts have stated that if both are mixed and if there is no direct linkage, then you can argue that it is outsourced out of my non-interest bearing fund. Second thing, whether that would also be another issue.
Yeah. Okay. So here I would not say that this interest allocation would be to the under coverage under ATI 8. It would be more under the ATI 5 and 6, where the section lays down you should compute the profit as if this was an independent only unit. So I would say yes, in this particular scenario ATI 8 may not trigger, but for the purpose of allocation, if that interest directly links to your, then if you can demonstrate that is mixed, then you are actually getting a debate and how far best you can demonstrate your case more than 51%, as the earlier speaker was saying. That's the litigation which goes on, but otherwise I think you should allocate that particular interest. Good. So thank you very much for your patient hearing. I really enjoyed talking to you all today on this matter. Yeah, thank you.
Friends, before we conclude this session, I just had one quick announcement to make. After our intensive study course on transfer pricing concludes next week, the Chamber is also having an intensive study course on FEMA, which will be a basic to a fairly advanced level knowledge of FEMA, which the intention of Chamber in preparing this course is to enable practitioners to get into the area of FEMA. The course is spread over 4 days, which is Friday and Saturday for 2 weeks, immediately after our transfer pricing course gets over, and it will be conducted at this very same venue, will be held in a classroom style. So if you're interested in enrolling, you could ask for more details at the counter. With that announcement, I would request Deependra to propose a very well-deserved vote of thanks for our speaker.
Thank you. In the evening session, in the domestic transfer pricing basic principles, the speaker has very well articulated. The speaker has very well articulated the FMV versus ALP. The burden of proof is shifted to the assessee in case of TP adjustment is there. He has also said two important cases, Tide Water Oil and Hindustan Lever. The valuable insight about the connected person definition, and international TP versus domestic TP, and the 4 case studies are also very, very good, and I think we should appreciate it, and I request everybody to give a very good round of applause. Thank you.